Welcome back to Investing Talk Podcast.
Today we're looking at Trump media.
As usual, before we start, subscribe, like, and comment to this video to support the show. It really helps us out.
And honestly, so what's here is just massive for you listening. If you're still looking at this as just a social media play or a proxy for polling numbers, you are completely missing the actual business transformation that's happening right now.
Right.
Because this is a company attempting a massive pivot into a multi-vertical fintech and digital asset firm. And they are sitting on a Bitcoin treasury that rivals some of the biggest crypto native companies in the world right now.
Okay, but I have to be the wet blanket right out of the gate here.
I wouldn't expect anything less.
Look, when I look at the history of this stock and frankly the valuations we've seen over the last couple of years, I just see a lot of hype. And a ton of volatility. It's really hard for me to separate the political noise from the actual profit and loss statement. Usually when you strip away the narrative, the numbers just do not hold up.
And that is exactly why our analysis today is so interesting. Because the market is entirely distracted by the noise, while the company is aggressively accumulating assets under the hood.
Okay.
There's this huge disconnect between the meme stock narrative you see on social media and the actual fintech holding company reality that is starting to emerge in the raw data.
Well, let's establish our mission for today then. We are just looking at the SEC filings and the raw market data here. No politics involved. We are completely impartial, just trying to see if this business pivot holds water.
Exactly. Just the facts and the filings.
Right. So let's pivot to the fundamentals here. Let's unpack this because I'm looking at the numbers for 2024, and to be honest, they look rough.
They do.
We have to start with the revenue reality check. For the full year, 2024, they reported $3.62 million in annual revenue.
It's a very small number.
It's tiny. To put that in perspective for you, $3.6 million is less than what a couple of high-volume fast food franchises pull in a year. And that is actually down 12.4% year over year from 2023. But the number that really jumps off the page, the one that makes my accountant brain actually hurt, is the bottom line.
The net loss.
Yes. They posted a massive net loss of $401 million. So you have a company generating less than $4 million in sales, losing $400 million. That is a burn rate that would terrify any CFO.
It is a terrifying number if you look at it as pure operational burn for a social media site. Like if they were spending $400 million just to keep the servers cool and pay developers, I'd completely agree with you. It would be a disaster.
Right. Money on fire.
Exactly. But if you dig into the why behind the filing, the context changes completely. That $401 million loss isn't just operational waste. It reflects a really aggressive capital deployment strategy.
Meaning they're buying things.
Yes.
Yeah.
They aren't just trying to sell ads on their legacy platform anymore. They're dumping capital into a Bitcoin accumulation strategy.
So you're saying this is less of a business loss and more of a wallet transfer? Taking cash and turning it into digital gold?
That is exactly what it is. Let's look at the specific holding because this is the real headline of the fundamentals. They have acquired 11,542 Bitcoin.
Wow. That is a lot of Bitcoin.
It puts them in the absolute top tier of corporate holders globally.
Let me do the math. They acquired it at an average cost of $108,000, right?
Correct.
So depending on where the crypto market is on any given day, they could be sitting on unrealized losses if there's a dip, sure. But that is over $1 billion in crypto.
Over $1 billion. You really have to frame this as a strategic treasury reserve. This gives them massive optionality. If the crypto market recovers or we get another major bull run, that treasury alone could be worth way more than the operating business.
It does remind me a bit of the MicroStrategy playbook.
They're very similar.
Where you turn the operating company into essentially a vehicle to hold the asset. But here is my issue with that comparison. MicroStrategy had a boring but profitable software business actually paying the bills.
Right, their legacy cash flow.
Exactly. How is this company keeping the lights on? You can't pay your staff's salaries with Bitcoin volatility. Well, not easily anyway.
And that brings us to the liquidity and the balance sheet, which is actually where I found the biggest shocker in the data we analyzed.
Okay, hit me.
You'd expect a company losing that much money on paper to be gasping for air, but look at their quick ratio. It is 42.78.
Wait, 42.78.
Yes.
Okay, let's just pause for you listening who maybe doesn't spend weekends with an accounting textbook. A quick ratio of 1.0 is generally considered healthy.
Very healthy.
Because it means you have $1 of liquid assets like cash or marketable securities for every dollar of debt you owe in the short term. A ratio of 42.78 means
It means they are absolutely flush with liquidity. They're swimming in it. They literally have almost $43 in liquid cash for every single dollar of liability.
That is incredibly rare, especially for a company that is technically losing money on the income statement.
It is rare. And a huge part of that safety net comes from the $1 billion in zero-interest convertible notes they issued. That gives them massive runway.
So they aren't stressed.
Not at all.
Yeah.
They aren't operating with a gun to their head. They have the actual capital to execute this pivot they keep talking about.
Okay, so they have the war chest. Let's talk about that pivot. Because you mentioned this isn't just a social media play anymore. If I'm an investor today, what exactly am I buying? Because a single social app clearly has a ceiling based on those revenue numbers.
You're buying a transition into a multi-vertical strategy.
Sure.
They're moving completely away from relying on a single app. The roadmap right now includes Truth.fi,
Which is what, exactly?
as their fintech arm,
I mean, that
and they are launching digital asset ETFs. Specifically, they filed for the God Bless America ETF, and they're rebranding the Point Bridge ETF. Plus, they're rolling out digital tokens.
God Bless America ETF. You can't say they don't know their branding.
They certainly know their audience. And that's the entire key to the thesis.
Yeah.
They are trying to monetize cultural alignment through sticky financial products, not just ad impressions.
That makes sense. Ad rates are a commodity.
Exactly. But if you can get someone to move their IRA or their daily savings into your ecosystem because they align with your brand values, that is incredibly sticky revenue.
It's the whole parallel economy thesis we've seen popping up.
Precisely. And there is a glimmer of hope in the revenue data that suggests the bleeding from the legacy business is actually stopping.
Oh, really?
Yeah. While annual revenues were down overall, if you look at Q3 2025, revenue was about $972,000, which was a decline of only 3.76% year over year.
So the rate of decline is slowing down significantly.
Right. It suggests they might have found a floor, the people who are there using the platform, or the core base. They aren't leaving. If they can layer these new fintech revenue streams on top of that stable base, the P&L looks entirely different a year from now.
It's a bold strategy, a total pivot from a social network to a crypto treasury fintech hybrid. But let's move from those fundamentals over to the technicals. Let's pivot to the charts.
Let's do it.
Because the price action here tells a story of a market that is just waiting for something.
It really is. It's like the calm before the storm on the charts.
Let's look at the current state. As of January 21, 2026, the stock is trading at roughly $14.10, and it has been stuck in this incredibly tight trading range between $13.31 and $14.78.
Very compressed.
Yeah. What stands out to me is the clustering of the moving averages. You have the 20, 50, 100, and 200-day moving averages all squeezed together between $12.05 and $17.04.
When you see that kind of compression on a chart, it's usually a coil. Energy is just building up. Volatility has collapsed, which almost always precedes a massive move. And the market is basically trying to decide which way to break because the price is literally running out of room to go sideways.
And the momentum indicators totally back that up. I'm looking at the RSI, the Relative Strength Index, and it is sitting right at 54.
Dead neutral.
Exactly. Mid-range. It's not overbought. It's not oversold. To me, that signals the market is waiting for a catalyst. The retail traders are just sitting on the sidelines.
But not all traders are on the sidelines. And this is where it gets fascinating. If you look back just a month or so to December 2025, we saw the stock hit oversold levels around $10.21. And what happened?
What did the flow show?
Institutional accumulation. We saw heavy buying volume stepping in to defend that $10 level. The smart money was quietly accumulating when everyone else was selling or bored.
So the floor is around $10.50, and the institutions are happy to buy there. That gives you listening a pretty clear risk level to watch.
Exactly. And recently we are seeing signs that something is brewing again. On February 17th, 2026, the data showed unusually high options volume. Plus, we are seeing whale alerts in communication services stocks that highly correlate with this.
Whale alerts usually mean someone knows something, or at the very least, they are positioning for a massive move. You don't make those kinds of options bets unless you have serious conviction.
It suggests that smart money is positioning for volatility before the general public even reacts to the news. They are betting that this tight trading range isn't going to last much longer.
Which leads us perfectly into the sentiment of the market. Let's talk market perception, because usually when you have big news, a stock moves. But here, we're seeing something really strange.
It's a total anomaly. I call it the sentiment gap. I looked at the sentiment scoring for the recent news cycle on this company. You have these massive announcements, and the sentiment classification comes back as neutral, literally a 0 out of 10 score.
0 out of 10 for things like ETF launches.
Yes. It's like the algorithms and the general market are treating these as non-events. Let's just look at the specific catalysts that are being completely ignored by the street.
Go ahead.
First, you have the Yorkville Partnership. They are acquiring the Point Bridge America First ETF. That is $32 million in assets under management just walking in the door.
See, that's real money. That's actual fee-generating assets. It's not a hypothetical app launch.
And it was completely ignored. Then you have the ETF filings from February 13. They officially filed for 2 digital asset ETFs, again, treated as neutral by the market. And then the token record date on February 2. That is a direct value transfer event for shareholders.
Wait, explain the token record date. What does that actually mean for the listener holding the stock right now?
It means if you held the stock on that specific date, you are recorded on the books to receive whatever digital token distribution they are planning, essentially a digital dividend.
And usually stocks rally hard into a record date because everyone wants the freebie.
Exactly. But here, the market just shrugged.
Why do you think that is? Is it just fatigue with the brand?
I think it's the boy who cried wolf effect, combined with intense political noise. People hear the brand name and they instantly think about elections or campaign speeches. They aren't actually looking at the SEC filings. They are treating these real business developments as political stunts rather than future revenue drivers.
And that is creating a mispricing.
The market hasn't priced these in because they think they're nothing burgers.
But there is one catalyst that feels a bit more out there. Almost sci-fi. And I know you want to talk about this.
The wild card. You cannot ignore this one. There is a speculative $6 billion all-stock merger with TAE Technologies on the table.
TAE Technologies, the fusion energy company.
Yes, fusion energy, targeting mid-2026. Now, I want to be clear, this is highly speculative. But if they pull off a merger with a fusion energy firm, you are talking about a completely different valuation model.
It's a completely different sector.
It's a lottery ticket attached to the stock. You go from being valued as a struggling social media company to being valued as a deep tech energy play.
It feels like they are throwing a lot of darts at the board here. Crypto, ETFs, fusion energy. It's a total conglomerate approach. But to your point, if even one of them sticks, the current price of $14.10 looks very different.
That's the entire point. And the analysts are actually starting to see it. Benzinga has a bull case of $13.80 for 2026, which is right around where we are now. But their longer-dated 2030 scenarios could go much, much higher.
Okay, but we have to look at the other side of the coin. It is time for the bear case. Let's talk risks. Because while fusion and crypto sound incredibly exciting, execution is boring and it is hard.
It is. Ideas are cheap. Execution is everything.
So risk number one is clearly execution risk. It is incredibly difficult to pivot a company. Pivoting from a social network to a fintech and ETF manager is not something you just do over a weekend.
Right.
There is absolutely no guarantee that Truth Social funds will actually attract assets under management.
That's a very fair point. Just because you build the ETF doesn't mean the capital will come.
Exactly. The ETF market is brutal. It's hyper-competitive. You're going up against giants like Vanguard, BlackRock, State Street. Fees are a race to the bottom. If they launch these God Bless America funds and nobody puts money in them, and the TruthFi app doesn't work, what are you left with?
The legacy business.
Right. You are back to being a social media site losing $400 million a year.
That is the nightmare scenario. You burn the cash runway, the new products totally flop, and you're left holding the bag on the legacy burn rate.
And then there is the volatility. We have to talk about the beta. The stock has a beta of 4.58.
That is extremely high.
For context, for you listening, the market average beta is 1. A beta of 4.58 means this stock is nearly 5 times more volatile than the S&P 500. If the market sneezes, this stock catches the flu. If the Nasdaq is down 1%, this could be down 5 or 6% in a day. That makes it very hard to hold if you have a weak stomach.
Definitely.
And on top of that, you have the regulatory scrutiny. We are talking about pivoting into crypto and finance. The SEC absolutely loves to regulate these areas.
They do, but let me offer a counterpoint to that regulatory risk. Look at who is in the White House right now. The current administration has taken a very pro-crypto stance. We've already seen SEC policy shifts, like dropping the lawsuits against Coinbase.
That is true. The wind is currently blowing in their favor on the regulatory front.
Exactly. In a different administration, launching a crypto exchange or a digital token might be a complete death sentence of red tape right now. Might actually be the path of least resistance.
Fair point.
And on the execution risk, you are right. They absolutely might fail. But remember that $1 billion convertible note we talked about earlier?
The liquidity runway?
Yes. That buys them 18 to 24 months to figure it out. They aren't going to go bankrupt tomorrow. They have the actual capital runway to make mistakes, iterate, and try again.
So they have time and they have a friendly regulator, but the execution burden is still entirely on them.
It is, but that's what investing is, right? Weighing risk and reward.
So what does this all mean for the listener? We've looked at the cash, the crypto treasury, the charts, the sentiment gap, and the risks. Bring it home for us. What is your final verdict?
When I look at the asymmetry here, the limited downside because of that massive cash and Bitcoin floor versus the huge upside if this fintech pivot actually works. I am giving this a bullish score of 7.2 out of 10.
7.2. That is a fairly confident score.
It is. The thesis is actually pretty simple. The company is currently a fairly valued option. It's trading at roughly 1.2 times price-to-book ratio. That is not expensive for a tech growth play. You're essentially buying a cheap option on the crypto market recovery and this new values-based investing trend.
So you don't see this as a hold forever Buffett-style stock?
No, not right now. This is a trade. I see this as a 3 to 6 month swing trade. We are targeting the Q2 2026 earnings. You want to be in for the token distribution and the launch of the ETFs to capture that momentum.
Give us the specific price levels.
You want to look for an entry below $13.50. That's near the bottom of that consolidation range we talked about on the charts.
Yeah.
If it dips there, the risk-reward ratio is fantastic. For an exit, I'd be targeting $18 to $20.
Why there?
That hits the 200-day moving average resistance, and it captures the hype cycle that should come with these new product launches.
So the play is basically buy the dip, ride the catalyst, and sell into the news.
Exactly. But I want to leave you with one final thought before we wrap up today. We've laid out this massive fintech pivot. If this parallel financial ecosystem actually works, if a company can successfully bypass traditional banks using cultural loyalty and crypto infrastructure, what does that mean for legacy banking a decade from now?
That is the real wild card. If they prove the model works, others will follow.
Precisely. The core question for you is, do you believe they can actually pull off building this financial ecosystem? Or is it all just buzzwords to prop up the stock price? That is the $400 million bet you are making.
Subscribe, like, and comment to support the show.